This is MSCI Perspectives. I'm your host, Adam Bass, and today is March 30th, 2026. Markets have rarely felt quite so complicated. We've got a war in the Middle East sending oil prices soaring. AI is reshaping entire industries as well as entire indexes. 50 years of home bias is beginning to unwind almost all at once, and a level of stock market concentration that has investors simultaneously grateful for the gains, but nervous about what comes next. So on this episode of MSCI Perspectives, we brought together three people who spend their days thinking through these exact questions from three very different vantage points. Kristy Akullian is head of iShares investment strategy at BlackRock. She has a front row seat to where real money is actually moving. Berg of MSCI is head of America's Index and has watched the evolution of index investing from the inside for nearly 2 decades. Last but not least, Abhishek Gupta is part of MSCI's equity research team and co-author of 2 recent papers that take a 50-year view of global markets. What emerged across our conversation was a story that builds on itself, from history to tools to what investors are actually doing about the situation today. We start with what Kristy Akullian is hearing on the ground in terms of the mood across different types of investors.
I wouldn't say that there's been one mood that has really defined the year. We have been through so many, whether it's sort of macro surprises or geopolitical surprises. I think investors are still grappling with what all that means for their portfolios. But we started this year with $100 billion plus months of ETF flows for January and for February. We've seen that slow a little bit in terms of investors allocating to equity funds in particular, just as they, again, sort of grapple with what's happening in the Middle East. So we've seen a little bit of a pullback in terms of risk sentiment across all of the client types that we talk to, but there's still interesting differentiations under the hood. So if we look at the advisory community within the US, we do see them being more bullish, more constructive on risk taking than institutions are right now. But both of them have come down a little bit over the course of March as we've dealt with more geopolitical headlines in the news. Where we started this year was from a very bullish position. So some of that reduction in risk appetite has kind of brought us back down towards long-term averages. We're not seeing investors race for the exits. We're not seeing them panic. We're seeing them be more opportunistic about where they're allocating to.
To understand why that recalibration is happening the way it is, it helps to zoom out, a long way out. I asked Abhishek why a 50-year historical view matters right now.
I think the value of history isn't really so much about predicting the future. It's more about where we are, how we got here, what's the pattern, and then what's the context. When we analyzed 50 years of global equity markets, there were certain dynamics that kept recurring. And these are very much issues that concern us today. Concentration episodes or changes in regional leadership, sector rotations, factor cyclicality. These all felt quite unprecedented for their time. But when we look back, they fit clear historical patterns. Now, these prior cycles don't tell you exactly what will happen today. They won't tell you what will happen to market concentration, when it will resolve. But what they do suggest is that treating current market structure as permanent is probably a mistake. History also reveals what's genuinely new, what's structurally different. Emerging markets, for instance, they didn't exist as an investable category before 1987. And today they are the largest segment by stock count. Another deep fundamental shift that has happened is the rise of indexed investing. So I would say that history can help us distinguish true structural shifts from cyclical episodes. And in my opinion, that is really where history's true value lies.
For most of the last half century, investors, particularly American ones, kept the vast majority of their money close to home. Now that story has been changing, and in 2025, as well as into this year, the change accelerated dramatically. I asked Abhishek about that. Abhishek, Where does that shift away from home bias fit in terms of the historical arc you've been studying?
So looks like, Adam, you've read the paper. Thanks for that. Historically, investors focused primarily on their domestic markets, driven by familiarity, regulatory limitations, custody challenges. However, the shift from domestic to global, uh, it's not really an investor preference, I would say. It's more of a necessity that has been driven by three forces: access, opportunity, and evidence. So, first, the removal of practical barriers such as capital controls or the operational challenges, they made foreign stocks much more accessible to investors. The second is investors started to recognize growth opportunities outside of their domestic boundaries and they wanted to pursue those opportunities. In parallel, what also happened is that the investable universe, it scaled massively, expanding from roughly like 800 constituents in 1969 to growing almost tenfold, 8,000 in the MSCI Akullian today. But most critically, the data also exposed the heavy penalty of home bias. So consider a Japanese investor who stayed largely local over this time period. They may have lost like decades of returns. Similarly, US investors who ignored international exposure in the 2000s likely missed the EM boom. The evidence kind of becomes too strong to ignore, and investors have likely realized that geographic diversification gives you access to growth, it reduces risk, and it also expands your opportunity set.
That shift is showing up directly in the flow data that Kristy tracks every day.
We've seen one of the strongest starts for international markets versus US markets in about 30 years. Emerging market ETFs in particular, they've gathered about almost $32 billion year to date. That's so interesting just in terms of composition, because we've seen international exposures in the first few months of this year make up almost 50% of total inflows. Even last year, which was a tremendous year in terms of international market performance vis-a-vis the US, that share was only about 20%. We've seen many investor types come around to this idea of allocating more to international markets. That said, I'll note that more of that momentum happened in January and February, but interestingly, we haven't really seen it reverse in March. We've just seen it slow a little bit.
Christine's 2 decades watching how indexes get built and used make her uniquely qualified to talk about some of the tools that make this shift possible.
When MSCI launched its first index, it was pretty straightforward. And those indexes began as active benchmarks. Eventually, they migrated, became the basis for passive institutional mandates, then on to indexed mutual funds, and ultimately, indexes became the engine behind the ETF revolution. And along the way, the toolkit kept expanding from a broad ability to cut markets by size, sector, geography, or in fixed income and factors and styles, offering new ways to tilt towards specific outcomes, whether it's quality or growth or value. And then a whole bunch of other tools arrived: more fundamental data, ESG ratings, climate metrics, and ultimately, and something we see a lot of today, proprietary IP. All of that can now be used within the toolkit and integrated directly into index construction. And that broadens what an index could express and who could use it.
For all the momentum toward global diversification, there is a countervailing force that has defined markets for years. That is extraordinary concentration at the top of U.S. indexes. A handful of AI-linked companies have driven outsized returns and created a genuine dilemma for investors. Do you address the concentration or do you ride it? And is what we're seeing now actually unprecedented historically?
Today, markets are very highly concentrated, but it's still not something that is unprecedented. Going back in history, markets have repeatedly clustered around some dominant winners. There are several episodes that we can recall from the past. The Nifty 50 of the 1970s, the Japanese banks from the 1980s, or the tech in the dot-com era. So while the concentration is not different, what is different is the source of that dominance. Today's mega caps largely cluster around the AI theme. And at the same time, they're not just speculative in nature. These are highly profitable firms. They are generating a ton of cash, and they are embedded in global economic infrastructure. Now, that makes the debate less about what is the concentration, what is the source of the concentration, but it's more about the durability of this concentration and how long this can sustain. History suggests that concentration eventually normalizes, but the timing of it can be highly uncertain. I think in this case, the real question is AI-driven businesses, for how long they can scale, and the network effects, how long that can help them sustain their leadership compared to past cycles.
Christine looks at that same concentration from inside the index itself.
In the MSCI USA index today, the top 10 names, they account for 35% of the weight. And so if you're sitting heavily in US exposures or US benchmark, a lot of your risk is concentrated in a handful of names. Global diversification can play a very significant role. History shows that holding across markets reduces volatility and drawdowns compared to any single country allocation, and that's even when correlations rise. But the point here is that investors have tools to address the concentration directly if they so choose. So global diversification, or you can cap or equal weight. You can design custom indexes for a single market. The tools available have broadened. And all of these things allow you to get that exposure, but not in such a way that you're completely abandoning a benchmark framework entirely.
And Kristy sees how advisors and institutions are actually responding to it.
I think it's very important as investors are looking at their portfolios, and even if their allocations haven't changed, maybe the indices that they're exposed to have. We know in the US that, large cap indices have skewed much more heavily into growth recently as opposed to value. And over the last several years, that has obviously been a boon to investors, and they have benefited from some of that US overweight, particularly in the advisory channel. But that said, I think that one of the reasons why they're considering international exposures where they haven't as much in the past is that they understand that they're getting different drivers of return and different drivers of risk in different markets. And that can help to balance out some of the stylistic tilts that may be unintentional if they're just staying in the exposures that they held previously, given the amount of growth that we've seen in certain styles and factors over others.
The word factors came up constantly in these conversations, but it's a word that can stop some investors in their tracks. I asked Christine to help define it in a way that makes it genuinely useful and understandable for investors.
One simple way to think about factors, they provide systematic returns, transparent way to express a view or specific outcome that you want to pursue, without having to pick individual stocks. Take quality. It's not just about avoiding trouble. It's about owning companies with very specific things: strong earnings, solid balance sheets, really good business models that are durable. That's an attractive standalone investment opportunity or allocation. It could also complement many other allocations. Another factor, minimum volatility. It allows an investor to stay in the market, capture growth potential, but helps you manage the ride a little bit. Right? And that matters a lot during times of volatility and with different investors who have other constraints. Factors used to be very research-oriented, research concepts. Now we can use them in portfolio construction. It's another tool.
Abhishek's 50 years of data gives those tools a sharper edge, especially when it comes to thinking about today's concentration.
I would say that one of the big lessons from history is that different factors, they tend to perform in different market environments. Let's start with momentum. Momentum, as we all know, allocates to recent winners. And it's a factor that would benefit from more concentrated markets, more trending markets. So if the investor had a view that the recent winners will continue to outperform and the markets will get more and more concentrated because of that, momentum is likely a strategy that will help them. But for those investors who may have a contra view, value or equal weighted approaches, they would largely gain when the leadership broadens. Minimum volatility, it would address concentration in a slightly different way. So instead of focusing on weights, it would actually target risk. So it would reduce the exposure to those stocks that contribute the most to portfolio volatility. In concentrated markets where a few names can dominate both weights and risk, this approach can help diversify the portfolio's risk profile. The choice depends on what an investor is trying to manage.
But factors cycle, sometimes for years at a time.
Value is a perfect example because it has absolutely tested everyone's patience. Years of lackluster performance has had investors or other market participants questioning whether the premium still existed. But that's the nature of factors and systematic, time-tested patterns. They're not arbitraged away precisely because they're uncomfortable to hold through a cycle. Those who abandon value at the worst moment are likely the ones who treated it as a short-term trade rather than a long-term structural exposure. Cyclicality, it's a feature. It's not a bug. It's what keeps a premium alive. The question isn't whether value or a factor did or still works. History and research is clear on that. It's whether your time horizon is long enough to let them deliver what they're designed to do.
Kristy, when the subject of factors comes up with advisors, where does the conversation usually start?
The ones we get asked about most are growth versus value. That is the accessible door in. And I think investors sort of, they understand the benefit in balancing some of those. Advisors have an almost perennial portfolio tilt in that they favor small caps, they favor value, and they favor US equities. What that means is that they're often left underexposed to technology, to communication services, to emerging markets, some of the strongest places to access that AI theme right now. So with the advisory community, I think it's more a conversation about getting back closer to benchmark weights. Whereas what we're seeing and hearing from institutions is really more of an active overweight story. They're being incredibly tactical. They are doing so through many of the single country ETFs that track MSCI indices as well.
Beneath the structural conversation about tools and diversification, there's a very specific, very real shock running through all these discussions. I'm talking, of course, about the war in the Middle East and what it's doing to energy markets, supply chains, and investor confidence.
So history shows us that geopolitical shocks tend to trigger sharp and immediate reactions from investors. Within weeks of these conflicts, we would see that markets are getting sold off. There is spike in oil prices. Investors are taking a much more risk-off approach. However, in many of these instances, we have also seen that the drawdowns are relatively short-lived, and equities, they typically recover within months once the uncertainty stabilizes. What we've also seen very common is that investors may just sell off entire market segments, even when the exposures that reside within their portfolios are a lot more nuanced. To back this up, I want to talk about the ongoing Iran war and some recent research that we did around this. So we uncovered some hidden exposures using MSCI economic exposure data, geospatial data, and supply chain analysis. What we found was that there are companies in India, US, Japan, Taiwan, and a few other countries that collectively have a weight of 2.5% in MSCI ACWI, and they are all tied to physical locations or physical operations that they have in the Gulf, either through offices, retail, manufacturing. So something like this would get entirely missed from standard country classifications. Another interesting insight is that there are Asian petrochemical refineries or power utilities that rely on Gulf oil and gas as core inputs. So, of course, as conflict happens, their businesses get disrupted. But it doesn't just end there. There are cascading effects. And these effects feed into many others, creating broader second order impacts with much more global ramifications.
2.5% of a global benchmark tied to Gulf operations, mostly invisible through conventional analysis. For Christine, the answer to questions about that kind of hidden risk comes down to one thing.
During any time of uncertainty, thoughtfulness, maybe a little bit of patience, and certainly precision matter. Making very blunt calls or broad-based decisions, exit this, enter that, move swiftly here, they may not lead to the desired outcomes. Not every EM country, for example, is the same. And so the shocks don't affect all things equally. So understanding which companies generate revenue from the affected regions, where they operate, how and where are they vulnerable, their supply chains, all of those things are very important and they all matter a great deal. So the tools that we have today and the capabilities to analyze vast amounts of data, structured and unstructured, coupled with all the advancements in AI, really can arm market participants, whether it's managers or investors, with much deeper insights. And those can help them make informed investment decisions instead of using, blunt instruments that they may regret in, short order.
The biggest question right now is just around, what higher energy prices and potentially higher energy prices for longer can mean to different geographic exposures. We know that Asian economies are more exposed to some of the oil that is specifically going through the Strait of Hormuz, or more specifically, not going through the Strait of Hormuz right now. That higher degree of sensitivity or that higher leverage to higher oil prices is just causing investors to step back a little bit in more of a wait and see mode. Right. So again, it's not that we're seeing wholesale changes to portfolios. We're not seeing reversals of really strong flows that started last year and really continued this year. But we are just seeing a little bit of a drop in terms of momentum as they assess what the risk landscape looks like more broadly. If the conflict continues, if energy prices stay higher, if there is a perception that they will stay higher for longer, what we've seen in polling data is actually just a switch in international preference from EM to DM, which is perceived as a little bit safer here. So again, it's subtle changes in terms of where they're allocating to. It's not a wholesale change in terms of the decision to continue to allocate and to build in more diversification.
Okay, so far we've looked back 50 years and at what's happening today. Now, of course, the harder question. What comes next?
I would say that there are three structural themes that could really define outcomes, and history actually offers a very good parallel for each one of those. So the first one is that what happens to US exceptionalism? What happens to its dominance? Does it persist or does it revert? The US as of today makes up about 62% in MSCI ACWI versus the low 40s that it used to be at in the early 2000s. But history also tells us that leadership rotates. Japan, for instance, it dominated global equity markets in the late 1980s, but eventually there was mean reversion. The US in itself has gone through decades of underperformance in the 2000s. So the lesson is that predicting timing can be really challenging, but what investors should really avoid is anchoring to current leadership. The second one is, how does AI reshape productivity and returns? Past technology waves from, let's say, the internet era or mobile revolution, they created both broad productivity gains and significant dispersion among equities. The dot-com era, for instance, is a reminder that while innovation can be transformative, markets often need to calibrate which companies capture that value. One thing that I found quite surprising was that emerging market companies offer almost as much AI exposure as US companies do. And the third thing that I want to mention is that how stable are market regimes. History shows us that regimes do shift, and sometimes quite abruptly. The lesson from 50 years of data is that diversification across regions, sectors, and factors tend to be more robust than optimizing for any single prevailing trend.
Christine?
We see more and more innovation, whether it's how to package it, how to deliver it, how to communicate. But there are certainly other things that will happen over the next decade. But I would say that longer term, tokenization certainly has the potential to fundamentally change how index-linked products are structured and distributed, enables fractional ownership, continuous settlement, access to strategies that today require pretty significant investments or operational infrastructure. Looking ahead, what's going to matter a lot over the next 10 years, the speed of insight. The competitive advantage will be how fast you can turn data into a decision. Right? That's where technology and indexing intersect quite nicely. And we're really focused on that at MSCI. Our clients are going to continue to innovate. Technology is going to help deliver more, faster, and better solutions that take innovation to the next level, things maybe we can't even conceive of today across asset classes.
And for any investors still on the fence about committing to a more globally diversified portfolio, Kristy had a clear message.
The most important thing is just diversified drivers of risk and return. You also get different quality tilts in different markets. You get exposure to different sectors, in Europe versus the US. And so geographic diversification is only one dimension of what you're getting from allocating internationally. And overall, that can create a much more diversified portfolio than one that is so strongly overweight in a home country or so strongly overweight in the US particularly. I think that a lot of the structural drivers behind the move towards international markets are still very much intact. Whether we're thinking about things like the AI trade and accessing different parts of that value chain through emerging markets, particularly in Asia, or if we're just thinking about some of the exposures that you might get, whether that's sectoral, whether that's factor or style-based, that you can get in developed markets. What we're seeing right now is a little bit of tactical headwinds around geopolitical uncertainty. We're seeing a still strong structural story in terms of longer-term tailwinds, and there's still a little bit of a question mark in terms of the direction of the US dollar. But I think that over the long term, that allocation is going to continue to play out.
That's all for this episode. My thanks to Kristy Akullian, Christine Berg, and Abhishek Gupta for sharing their insights. You can find the research we discussed, including factor indexing through the decades and global equity investing through the decades, on the Research and Insight section of MSCI.com. In our next episode, we'll be back with the Q2 edition of Investment Trends in Focus, where Ashley Lester, MSCI's Chief Research and Development Officer, and Akullian, Chief Client Officer, take stock of where we are and what investors are watching most closely as we head toward the second half of the year. Until then, I'm your host Adam Bass, and this is MSCI Perspectives. Thanks for listening.